want to invest in real estate. You know, these 2 points, the first one and the last one, would probably be the main one that you make a decent amount of return. And when I say decent, I mean more than inflation. Because if you're investing in financial assets, it is going to, let's say you invest in a bond which pays 3%, right? And if inflation goes up, it goes up to 4%, 5%, then I mean, you're actually losing money. And the bond price will even come down. So you're losing on the coupon, which is less than inflation. And if you want to go and sell the bond, you take a hit on that as well, right? Now, compared to that, if you're getting into real estate, if inflation goes up, the real estate value will go up and you will have your capital appreciation. And then you can even try and negotiate with the people who are living there or renting that warehouse or shop or whatever it is, right? That try and increase the rental. So that's why this is a very good asset class. And especially if you're getting into long-term leases, you could lessen the impact of that economic shock. Now, again, I cannot emphasize on this enough that when we say diversification because of low correlation with other asset classes such as stocks and bonds, not true for listed securities of REITs and other shares of corporations, right? So, I mean, if you're investing in a corporation's share that is into real estate or you're buying units of REITs, that correlation is very high. When the market crashes, these securities also crash, right? So, when we say low correlation, what we mean is primarily if you're directly investing and getting the benefit, right? However, if you're indirectly investing, you're getting the dividend from the REIT. That part, okay, I agree that if the REIT itself has locked in those long-term leases and it is benefiting from that capital appreciation and that income, and it is passing that benefit out to you as dividends, which it has to, right? Between 90 and 100% of the income, it has to pay out as dividend if they want that tax benefit. So that part is true, right? But you cannot sell it. You have to hold it and you have to wait for that dividend. So as far as selling the units is concerned, that is going to be not giving you that diversification benefit, because when the market will crash, this will also crash. And to be honest, it's true for direct investment as well, because I remember in 2008, there was real estate. Even if you were having direct real estate, you couldn't sell it because the market had just crashed. So, yeah, direct investment has that long-term lease benefit, which you can get through REIT as well. The only thing which direct then has, which REIT doesn't have, is that tax benefit, right? When we talked about that in the previous video. So, the return comes from the income or the capital gain or a combination of both. A majority of the return is obviously income, right? Capital, and it's more consistent. Capital gain it just kind of comes when it comes, depends on what's happening in the overall economy. Real estate has this very weird behavior. It jumps once every few years and then just doesn't jump for a number of years. And it depends from country to country and city to city, but it doesn't go up like this, right? It kind of just stays stable and then jumps and then stays stable and then jumps. So it has a very weird behavior. Anyways, so you can kind of like say the income part is similar to a bond and the capital gain part or the speculative part is similar to a stock, right? So it kind of gives you a bit of both. So interesting space to be in. Now, investors prefer it for the ability to provide high, steady current income, has low correlation with the other asset classes. However, periods of a crisis, the correlation becomes highest during steep market downturns. I think we have talked about this in a substantial amount of detail now. Now let's move into infrastructure. And this is a very interesting space because if you talk about risk and return, sorry, risk comes here and return comes here. And if this is like, say, the bigger picture with equity being over here and then different stages of debt. So I would say, let's say, distressed debt being somewhere over here, or unsecured debt, and then secured debt, right? Infrastructure is down here. And this is something that is discussed in the earlier modules on alternative investment, that you're already in the lowest part of the risk and returns, very, very safe investments. Now, what we are going to do in this discussion is that we're going to blow this up, right? So we're going to be looking at the same risk and return parameters, right? But we're going to take that infrastructure area and we're going to blow it up. And we're going to see, okay, what's going on inside that? Are all infrastructure investments the same, right? And if not, then what are the different types? And then how are they having higher or lower risk? So even if you want the lowest risk, then what do you go for? And within that space, if you want higher risk, what can you go for, right? So let's get into it. Infrastructure, you've got your very, very solid, real capital intensive, long lived assets, right? And they could be either for economic use or social use. So they're intended for public use, but then we're going to break up this public into economic and social. So for example, healthcare is social, right? A school, university would be social. Power plant, airports, etc. will be economic. So we'll just get into that breakup as well. And then within those, how can we further classify them? But first, you have to understand that these are completely different type of investments, right? We're not talking about residential commercial investments over here. This is completely different. And usually, historically, what has happened is because they're so unique and so illiquid that the government has been doing them. But now, what we are seeing more and more is that the private sector is getting involved more and more with the government. And that's probably because the government feels that a little bit private sector involvement brings efficiency. So you can incentivize the private sector to come in and then try and make sure that they're running a tight ship. So more and more what we're seeing is public-private partnerships over here, but there is no private-private situation over here. It is either purely public or public-private, because this is huge projects and you cannot do it without the government backing. Of course, both income and capital appreciation can be there in terms of the returns. Now, how does the return come, right? First of all, think of roads, bridges, motorways, highways, etc. So toll, tax, right? Fees for using the facility. Or you can have availability payments, capacity payments. So for example, think of an airport, right? That we make the airport available for you. You can land your planes here whenever you want. But you have to pay us a payment for that, right? Or think of power plants that say, okay, we're going to make this much electricity. Now, whether you want it or not, whether you take it or not, that's not our problem, because otherwise the electricity is going to go to waste, right? So you take or pay. But the pre-agreed volume is there that, let's say, we're going to make 10 megawatt worth of electricity. Either you take it or either way you have to pay for it. Now, these are all the different ways of generating return on infrastructure assets, which were primarily owned, financed, and operated by the government. But now what we are seeing is more and more involvement of the private sector, and most likely it is because to increase the efficiency and incentivize the private sector to come in and help the government run a tighter ship. How that is done, we have contracts, of course, long-term contracts to maybe bring them in at stage of absolutely green investment, right? So now if you blow up that infrastructure part, and then you see which one is the riskiest one. So I would say green is the highest risk. So green will come somewhere over here, right? The highest risk and the highest return, because nothing exists. And then you will have your brown somewhere lower, right? Because something exists. You just have to expand it. And then even lower than that is your secondary stage, which is no need to expand. Everything is ready. Just come and you operate it. So we'll get into that green, brown, and secondary stage. But before we do that, let's talk about the underlying assets, right? What are we talking about? Are we talking about airports or are we talking about hospitals, right? So within economic, you can have for transportation, communication, social, etc. So transportation examples are roads, airports, bridges, tunnels. Within utility, you will have your electricity, gas, and all this. Communication includes telecom towers, information and communication technology infrastructure, and then of course within social you have your education and healthcare. Now, this is the interesting area. And again, from an exam perspective, I think a typical question could be which one is the highest risk and the highest return. So, greenfield is the highest risk, highest return. And your secondary is lowest risk and lowest return. Because see, in secondary, everything is ready. Everything is ready, right? Brownfield is like it's half ready. You have to still expand the facilities. You have to do some capital expenditure. And also, by the way, let me tell you, very few investments actually reach that secondary stage, because in this type of space you never really are fully ready. There's always something that needs to be added, and even if not added, needs to be fixed. I mean, think of an airport. Do you think it's always like just done, right? There's probably something or the other that needs repair, something or the other that needs fixing, or expansion is going on, or something or the other will be going on. So it's very, very rare to see an infrastructure investment actually at that secondary stage. But if hypothetically one does get there, which means nothing needs to be added, it's just ready and you just need to manage it, well, that would be secondary stage. Very low risk, very low return, right? But it's a nice place to put your money in if you have, let's say, if you're a pension fund or something with very, very low risk appetite. Right. So you can either directly invest, you can do it indirectly. Of course, we've talked about all the different modes that are available for indirect investments, and whichever form you choose will impact the income, the liquidity, the cash flow that you will get, right? Advantages of directly investing is that you get control, you get full value, tax benefits are there. Downside is you can only invest in one or two, so you have your concentration issues, liquidity risks, because you might get stuck with a bad investment, right? Diversified portfolio will be more liquid and more diversified. So, how could you go about doing this if you want an indirect portfolio? You could go for a fund, you could go for an ETF, and you already know what is the difference between the two, right? Fund could be open and closed. Closed can be traded during the day, but new investment is not possible. Open, new investment is possible, not possible to trade them during the day. ETF, best of both. Or you could invest in the stock, shares, equity of your companies that do this type of work, right? If you invest in that type of companies, if investing in publicly traded infrastructure companies, that's good because you can sell their shares and get out when you want, right? They will be telling you whatever is their financial situation by reporting through their financial reporting. So you understand what's going on. So transparency is there. You can even get into master limited partnerships, right? Which are like REITs that are just going to pass through the income that they get. And that's also an interesting way of investing in infrastructure. This could be done both privately and publicly, right? And this could be at different stages as well, where you have absolutely zero cash flow and you're having a very, very long time horizon. Now, why I'm saying that this is at the very lower end of the risk and return, because the government is involved, there's very, very low chance of default. So what you have is very low default rates. The asset quality is very high. So even if worst case scenario, the project is shelved, right, the asset is there. So it is probably the most safest investment you can get into. And then, so within that, if you break it up, right? So this exhibit that you see from the curriculum, it is actually this part only, right? In the risk return, you have equity over here, you have other things like unsecured debt, secured debt, but here we're talking about very, very secured, solid assets, government backing, right? And then even within that, so you have green over here somewhere at the higher end of this, and then brown in the middle, and then secondary stage at the bottom left, right? Secondary stage is everything is ready, existing toll roads, right? Nothing needs to be done, just collect the toll, or hospital is there, just collect the fees and whatever charges, etc. Brownfield, you might need to upgrade the power infrastructure, upgrade the port a little bit. So some upgradation requires, or expand the airport a little bit, right? Or if you are making a completely new airport or a new toll road or completely new power plant, well, that is going to be green, and that is very risky. And another word you must associate with green and high risk is demand based, right? Because you're making a new toll road. What if people don't want to use it? What if they don't want to drive on it? You can't force them, right? So that's the risk you're taking, right? The lower parts over here is existing toll roads that they are already there, people are already using it, so the risk you're taking is very less. And of course, you have your regulated industries where even if they are not using, it's a take or pay situation where even if they don't use, they still pay you for it. So greenfield has the highest expected return, highest risk, right? And secondary has the lowest expected risk and return. A very important point, highly likely that you might get a question on this. Right, investment in social services, hospitals, etc. also lower risk because the return is take or pay oriented, right? So even if the people are not using, you're still getting paid. But when you talk about demand based, now that is risky because if people don't use it, then well, you don't get paid. What's the benefit of this space? Of course, you get a steady income, for possible capital appreciation as well. You get diversification benefit from your traditional investments, you get protection against inflation, and you can have a long-term liability matching such as pension funds. So let's say a pension fund needs 5% return over the next 20, 30 years. Well, you could invest in this space and try and see if that 5% can be made available to you. So that is it for this learning module. Let's have a look at the summary. So real estate includes two major sectors, residential and commercial. Please keep in mind that part of residential which is being invested in for return, if you're not living in it, well, that is commercial as well. Real estate is very, very different from your other asset classes. Every property is different. So heterogeneous means different. Fragmentation is not possible, right? You cannot say I'm buying half this room. Or half this apartment or half this house. Maybe it will happen in the future. Maybe you're going to come up with a startup that does it. I don't know. But right now, it's difficult to say I'm buying half this room. Challenges in price discovery because the transaction frequency is much lower than what you have in your other asset classes. It's costly to buy and sell. There's fees, there's taxes, there's registration, stamp duties, etc. And it's a time consuming process. Then we talked about public and private and debt and equity based. So we said public, so we said private and equity, right? So here was private and here was equity. And then we said, okay, private debt, and that's where the loan was. So this is where we started from. And then we said you could have REITs, which are public and equity, and you can also have REITs, mortgage REITs, which could be public and debt. And then of course there were more within that box. How do you get the return? Income or capital appreciation or a combination of both. They are good because they kind of give you the benefits of both bonds and stocks. So bonds because of that stable income, and stocks because of the possibility of capital gains. And theoretically, they do give you that low correlation with other assets. So you have the diversification benefit, but that correlation gets high during steep downturns. Now, what else do we have? Infrastructure, of course. Capital intensive, real long lived assets. Very, very low risk, low return overall. But within that, if you blow it up and see what's going on inside, greenfield is the highest risk. Brownfield in the middle, secondary stage, lowest risk and lowest return. You can do it in partnership with the government, and that is where your public-private partnerships come in. And again, this space is direct and indirect investment is possible. You can do it through funds. In terms of indirect, you can do it through ETFs. You can do it through partnership agreements as well, right? Greenfield have the highest risk, highest return, and the advantages are you get a steady income stream, there's potential for capital appreciation, low correlation, so the diversification benefit is there, protection against inflation, and very good for pension funds because they can match their liabilities with the returns.